Jobs, inflation, the Fed. The U.S. jobs report came out on Friday. The traders who were hoping for a reversal of the trends for 2022 that has seen U.S. dollars soar, stocks tumble, and yields surge were clinging to the hopes for something on the light side. Something like a salad off the menu to keep the early week idea going of rebounding stocks, falling or steadying yields, and a declining dollar. That would be the Goldilocks entree that would keep those traders full, happy, and hopeful. Instead of a salad, it was the Monaco focaccia with half fries and half onion rings and a beer to wash it down. The markets were bloated instead. Yields moved higher, stocks tumbled, and the dollar moved higher. Non-farm payroll came in at 263,000. That was higher than the 250 estimate. There was an 11,000 two-month revision to the prior months, adding to the better than expected entree. It sure tasted good, but we got a little more bloated. The average hourly earnings came in as expected at 0.3%. The year-on-year was lower, however, at 5.0% versus 5.1%. That was also lower than the 5.2% last month, but still relatively high. Unemployment rate fell to 3.5%, which returned the level to the lowest this year and at lowest in a half century as well. The participation rate fell to 62.3%, which was lower than the 62.4%. The Fed wants more participation to increase the number of jobs being filled, especially in the leisure and hospitality sector, which continues to show a deficit of jobs relative to the pre-COVID levels. This week, the U.S. PPI and CPI data will be released for the month of September. That inflation data is going to be key for the trends going forward. The PPI will be released on Wednesday with the expectations for 0.2% versus the minus 0.1% last month. The year-on-year is expected to dip to 8.3% from 8.7%. The short-term trend is down, but the number still remains elevated. The ex-food and energy is expected to remain unchanged at 7.3% in the current month. The high reached 9.2% in March 2022, and moving down to 7.3% is still good, but it's remaining steady this month. For the more important CPI to be released on Thursday at 8:30 a.m., the month-on-month numbers are expected to show gains of 0.2% for the headline, but a high 0.5% for the core measure. That core measure comes in after a 0.6% rise last month. Those numbers are a concern, especially if you consider the recent move back higher in gasoline prices seen in the U.S. and the OPEC cut in production as well. The year-on-year for the headline is expected to dip to 8.1% from 8.3%, but the core measure is expected to rise to 6.5% from 6.3%. That is not good news for inflation. That ain't going to do it. So the jobs data came better than expectations. The upcoming inflation data is still not that great, especially when you consider the tight labor market. You simply can't ignore 3.5% unemployment. The core CPI data is still key, and that's not moving down. And that's a problem. Now, I know the Reddit boards might be filled with anecdotal stories of how there is no hiring going on in big tech, how people are being let go. That is likely true. But the Fed is okay with that. The Fed is coming to the party late after the great COVID stimulus that shoved free market in the market for too long and is now tasked to reverse that trend. That means the Fed is happy if the tech workers who make $250,000 can't hop to that new job every 6 months and instead have to accept something less or may even not get a seat in the musical chairs from a job slowdown. The Fed is happy that the house prices are not rising anymore. They are happy that the rip-roaring stock market is not rip-roaring anymore. Is the Fed happy that people can now earn a decent return from U.S. Treasury debt? Yes. That was a shift seen this week after the U.S. Treasury yield moved to 4.01% last week before moving to 3.5% and closing at 3.8% this week. If you can make 4% and the Fed is able to get inflation back to 2% sooner rather than later, that is great news, especially for the aging baby boomers. There is a choice versus just having to put it in risky stocks or in a bank CD that pays less than U.S. government debt. So what about the Fed? The comments from the Fed officials this week were still more toward their goal to kill inflation. It is not dead yet. And with 3.5% unemployment, they are still walking on a high wire tightrope with no nets. Does the Fed want to crash? No. Will they avoid one? Unknown. But with 3.5% unemployment rate, they are focused on getting the rates to restrictive. That means to get to 4.5% by the end of the year and maybe 4.75% by the first quarter of next year, and then see what happens. What does that do to earnings and multiples? Friday took the winds out of the bullish sails, I feel. For the Nasdaq and the Dow, they closed back below their 200-week moving averages after trading back above at the start of the week. Yes, the major indices were still up on the week thanks to 5% plus gains from Monday and Tuesday's trading, but the buyers had their shot. They missed. Of note for this week, and the one technical hope, is that the S&P is still above its 200-week moving average at around the 3,600 level this week. The price closed at 36.39. Watch the 3,600 level in the new trading week. Move below and the technical picture weakens further for equities. Analysts seeing earnings moving lower along with multiples are targeting around the 3,000 to 3,200 level as a key target level given lower multiples and lower earnings. That is still 11% to 16% lower. Keep that in mind. What about the US dollar? The dollar last week turned more short-term bearish at the start of the week, but recovered into the close. What did that price action do to the technical bias? Where are the risks? As risk is always number one in traders' concern. And where will the targets be?